Hi everyone. Welcome to Positioned.app. Today we're diving into one of the most widely used momentum oscillators in technical analysis, the Relative Strength Index, or RSI. Understanding RSI can significantly improve your ability to identify potential market reversals and confirm trend strength. The Relative Strength Index, developed by J. Wells Wilder Jr. in 1978, is a momentum oscillator that measures the speed and change of price movements. It oscillates between 0 and 100, providing signals about overbought or oversold conditions in the market. Think of RSI as a speedometer for price momentum. It helps you understand not just the direction of price movement, but the velocity and potential sustainability of that movement. The mathematics behind RSI might seem complex at first, but the concept is straightforward. RSI is calculated using this formula: RSI equals 100/100, 1 plus RS, where RS equals the average gain divided by the average loss over a specified period, typically 14 days. Let's break down how this calculation works in practice. Step 1. We calculate the price change for each period. Step 2. We separate these changes into gains, positive, and losses, negative. Step 3. We calculate the average gain and average loss over the specified time frame. Step 4. We divide the average gain by the average loss to get the relative strength, RS. Step 5. We apply the formula to convert RS into the RSI value between 0 and 100. Traditional interpretation of RSI focuses on these key levels. RSI above 70 indicates an overbought condition, suggesting a potential reversal downward. RSI below 30 indicates an oversold condition, suggesting a potential reversal upward. However, as beginners or developing traders, it's essential to understand that these are not absolute buy or sell signals. Market context matters tremendously. During strong bull markets, RSI may remain in overbought territory for extended periods. Similarly, in strong bear markets, RSI can stay oversold for quite some time. This is why we need to look beyond simple thresholds. It's crucial to adjust your RSI interpretation based on market conditions. Let's examine how RSI behaves in these two fundamentally different market environments. On the left, we have a trending market, specifically an uptrend. Notice how price forms a series of higher highs and higher lows, with predominantly bullish green candles. In trending markets, RSI does not behave in the traditional overbought and oversold manner. Instead, it shifts its range, typically holding above 40 in an uptrend and below 60 in a downtrend. This reflects sustained momentum. So when RSI pulls back but remains above 40, it often signals a continuation opportunity, not a reversal. In this context, RSI is better interpreted as a trend confirmation tool rather than a mean reversion signal. Now contrast this with the ranging market on the right. Price moves sideways between support and resistance levels, with no clear directional bias. In this environment, RSI behaves much closer to its textbook definition. It oscillates between 30 and 70, providing more reliable overbought and oversold signals. When RSI approaches 70, the market is relatively overbought and prone to pullback. When it nears 30, the market is relatively oversold and may rebound. The same RSI reading can mean something very different in a trending market than in a range, which is why RSI should always be interpreted within the context of market conditions. Let's translate this knowledge into practical trading strategies. First, identify the market condition, analyze price structure, and identify trend type, uptrend, downtrend, or range. Second, adjust your RSI interpretation accordingly. In trending markets, use RSI to identify pullback entries. In ranging markets, use RSI for overbought or oversold signals, 70/30 levels. Lastly, watch for transitions. Markets transition between states, and be prepared to adjust your RSI interpretation. The most common mistakes traders make are applying ranging market RSI logic to trending markets, prematurely exiting strong trends, and missing critical entry points by waiting for perfect RSI conditions. This is why context is so important. Blindly following RSI signals without understanding the broader market environment can lead to poor trading decisions. The standard 14-period RSI with 70/30 thresholds can be customized to suit different trading styles and time horizons. Adjusting the RSI period or its thresholds allows traders to fine-tune sensitivity and signal accuracy. Shorter time frame, 7-day RSI, increases responsiveness and signal frequency, ideal for short-term traders, but also raises exposure to market noise and false signals. Longer time frame, 21-day RSI, smooths out volatility, highlighting stronger, longer-term momentum shifts, better for position traders. Tighter thresholds, 80/20, produces more conservative signals, reducing false alerts but causing delayed entries and exits. Looser thresholds, 60/40, identifies early trend shifts and offers timely entries, though with a higher risk of premature signals. Remember that these modifications should align with your trading strategy and risk tolerance. In our next video, we'll continue on part 2 of RSI, which will be talking about the limitations of RSI and how to integrating RSI with other indicators for more comprehensive analysis. If you found this helpful, like and subscribe for more trading education content. Also sign up for Positioned.app for real-time swing trading signals. Let's make smart trading decisions together. Thank you for watching. Until next time, happy trading!